First part we're going to start with is what exactly is a note, specifically what is a promissory note. Then we're going to go over what exactly a note receivable is, and then we're going to switch over to notes payable and see where exactly they show up when you're looking at a full balance sheet. All right, let's dive into this. What is a promissory note? A promissory note is a legal financial document. It's a contract between one party and another party, and they're promising, one party is promising in writing to pay a specific sum of money to that other party in the future at a specified date. It's essentially a formal written promise to pay a debt. Now, with promissory notes, you're going to see certain key components. These are the common things that you're going to see with promissory notes. So it's going to be the date issued. This is the date the note was created and when interest is starting to accrue. You're going to see the principal amount, how much was borrowed. You're going to acknowledge the parties involved, who's lending the money, who's borrowing the money. What are the payment terms? When is this note? When is this promissory note due in the future? Is it a year, 2 years, 5 years, 10 years? When is it due? What is the interest rate? This is the cost of borrowing those funds. The repayment schedule, is it monthly? Is it quarterly? Is it annually? When do you have to make payments on the promissory note? And then the maturity date. When is the promissory note mature? When is it fully due? When does it need to be paid off by? And then also you're going to see items like default clause. Like what happens when the borrower defaults on the loan? It does not pay the lender back for what they've borrowed. You're going to look at terms. Is it secured or unsecured? Secured means there's underlying asset that is supporting or attached as collateral to the promissory note. This could either be personal property, real estate. It can be whatever you've defined in the promissory note as collateral, or it could be unsecured where there is no collateral. There's nothing underlying. There's no underlying asset attached to the promissory note. In that situation, if the borrower defaults, you're guaranteeing you're taking that borrower to court to try to claim any sort of funds back from whoever you lent money to. So those are the basic terms, the basic aspects or key components of a promissory note. So now let's talk about a note receivable. This is the first item we're going to look at on the balance sheet, and this is going to be an asset. You're going to see a note receivable on the asset side of the balance sheet. A note receivable is a written promise from a debtor to pay a specified amount of money to the creditor at a future date, basically redefining a promissory note. This is the written promise documented in a promissory note that one person is borrowing the money and another person is paying it back. And in this situation, since it's an asset, we are the lender. We are lending money to someone else, and this note receivable is an asset to us because we're expecting to collect this money in the future along with some interest. So let's take a look at a note receivable on our balance sheet, and let's just go through the motions of what that looks like and how it impacts the balance sheet and how it impacts the income statement. Here we have a couple. I'm going to hide the notes payable here. We have two examples of notes receivable. In this situation, we're working with Skynet Enterprises, and we have two employees that have bought shares from Skynet. We have Douglas Quaid and we have John Kimball. They bought shares of stock from Skynet Enterprises, but they did not have the money, the cash to buy those stock. So what Skynet Enterprises did is they issued a note receivable. Basically, they issued a promissory note to Douglas Quaid and John Kimball in exchange for the shares that they received. Now, Douglas Quaid and John Kimball will be paying back these notes receivable over the terms that we're going to go through very shortly. And that is how they're going to recuperate the cash or get the cash for giving these employees shares. First one on our line item here, the GL account 1800, which is our notes receivable. Douglas Quaid took out a note receivable on 1/1/2022 for $80,000. And the lender in this situation is Skynet Enterprises. That's why it's an asset on the balance sheet. We're expecting to collect that cash from these employees. And it's a 4-year promissory note. It's going to get paid back annually. You go to annual payments at a 3% interest rate. I actually wanted to clear these out. We're going to use the payment function to calculate the payment for these promissory notes, the annual payment, and the collateral in this situation of shares of Skynet. So if Douglas Quaid defaults, he does not pay back this loan, Skynet's going to take the shares back from him, and they're going to kill the loan, but Douglas Quaid does not have the shares. And this loan is due 4 years from the time it was issued. So the maturity date is 1/1/2026. So I want to show you the payment function because this is a real easy function in Excel where you can use to determine how much your monthly payment, quarterly payment, annual payment is going to be on a note. We're going to do equals PMT, paren. We're going to grab our interest rate. Now note, if you had a monthly payment, you would want to divide the interest rate by 12. In this situation, our N is going to be the number of times we're going to be making payments. If it was monthly, you would do 48, 4 times 12. But in this situation, it's an annual payment, so we're just going to do 4 years. And then I need to put in the present value. What is the present value of the loan? Now, in order for this to work properly, I need to put a negative in front of the promissory note. And then our next line item is what's the future value? Since we're expecting this loan to be fully paid off, it's 0. So I'm going to close this. Got my formula. Based upon the terms and using that payment function, I now know Douglas Quaid's annual payment, which is principal and interest, is $21,522.16 to pay off this loan in 4 years. And we'll prove that out in a second. I just want to run through the second note receivable that we have here for John Kimball. Same scenario, except this was issued 1/1/2023 for $130,000. Same lender, Skynet Enterprises. 4 years, annual payments. Interest rate went up a little bit, 3.5%. We'll skip over the payment real quick. Collateralized by the shares of Skynet, and the maturity date is 4 years from the date of issuance. So let's just run through the payment function real quick again so we can figure out what our payment is for this loan. So going through this again, we're going to grab our rate. It's a 4-year loan, 4 annual payments. Our present value is going to be negative what the principal lent was. And then our future value is 0 because it's going to be fully paid off. So we know what our annual payment is now using the payment function. Now we're going to take this next step because I want to know, specifically for the balance sheet and for the income statement, what is the balance on these promissory notes over their life? And what is the interest income that's going to be generated from these loans that I've issued for the shares of stock? So let's go over Douglas Quaid real quick. So his principal for those shares was $80,000. Year 1, we got 3% interest. So we're going to take that. I'm going to throw some dollar signs in there because we're going to end up dragging this down. In that first year, $80,000, Douglas Quaid's promissory note is going to generate $2,400 of interest income for Skynet Enterprises. Now I'm going to grab my payment that we calculated here. And then we're just going to go through the motions. So we issued $80,000. It generated interest for the entire year. We're going to make the assumption that Douglas is making these payments 1/1/23 of the following year. It's not happening during the year. So the ending balance for year 1, $60,877.84. And we're just going to run this out for the life of the loan and just prove out the payment function. This is our note receivable amortization schedule. So let's do the same thing for John Kimball. We'll grab the $130,000. We'll calculate the interest. Let's grab the payment. And we'll go through the motions. Drag that down. Drag this down. And we're going to take the ending balance, and then we can drag this down. Boom, 0. So I have my amortization schedule for these 2 note receivables. This is how they're going to be paid off over the 4-year term. So let's layer this now into the balance sheet and the income statement. We'll do the income statement first. So income statement. For this example, let's grab how much interest income generated related to these notes receivable in 2023. Grab that number, and we'll grab that number. So based upon the 2 notes receivable that we issued for the shares of stock that they purchased, we're going to generate $6,376 of interest income. Now let's do 2024. Same concept, except we're going to grab 2024. So in 2024, $4,706. You notice that it went down. And as these notes get paid off, since the principal is less, there's going to be less interest income, even though we're at the same interest rate. All right, let's head over to the balance sheet. So we're going to put our note receivable balances for these two notes as of 2023. And again, I'm making the assumption that he is making, both these gentlemen are going to be making their payments at the first of the year, the following year that they took out the loan. So in this scenario, I'm going to grab the principal balance and I want to grab the interest that is accrued because he hasn't paid that back yet because he's paying it on the first of the following year. And I'm going to do the same thing with John for 2023. So you could break out the interest if you want, but I'm just combining the two. The note receivable is reflecting the principal owed, and it's also reflecting the accrued interest in this scenario. And since these are not due within 12 months, we're going to treat them as non-current assets. Now, if they were due, you could collect within 12 months, you would put those in current assets. So let's do 2024 as well. So 2024, I'm going to grab the principal, I'm going to grab the interest. For Douglas Quaid, I'm going to do the same thing for John Kimball. All right, that's my note receivable. That's including the principal that we're still going to collect, plus the interest that is accrued. So that is notes receivable. They are assets that are on your balance sheet. They're going to generate interest income. Now let's change that and look at notes payable. Same, very similar concept, but on the other side of the balance sheet. Notes payable are going to be liabilities. This is not where you are the lender. You are the borrower. You are borrowing money from someone else, and you're paying it back over the promissory note terms. So let's look at a couple examples. Let's get rid of our assets. Bring in our liabilities. So our two notes in this situation are two notes payable, GL account 2800. We've taken out a note to buy network equipment from Allen Schaefer Technology Limited. It's a 5-year promissory note for $120,000. It was issued 1/1/2022. I'm going out of sequence here. At a 5% interest rate. And we'll do that calculation just real quick. We'll do that annual payment again for repetition. These are secured. The collateral is going to be what we purchase under these promissory notes, and the maturity date is 5 years from the issue date. So let's just do the payment for this. We're going to use our payment function in Excel. So we need to grab our interest rate. It's a 5-year loan with 5 payments. So we're going to put 5. Present value, we're going to negative what we borrowed. And again, future value is going to be 0 because they're expecting that we've paid this in full. So our annual payment for borrowing money for this network equipment, $27,716.98. Now we have this other note payable for desk and furniture, same concept. The date was issued 1/1/23, $80,000 from Al Pal Business Furniture. It's a 5-year payment term, annual payment at 6%, and it's secured by the furniture. If we default on this promissory note, they'll take the furniture back, and it's due in 5 years. We'll quickly run through the payment function one more time. So I'm going to grab our interest rate, 5-year loan, 5 payments, present value, what we borrowed, and they're expecting us to pay it back, so the future value should be 0. Annual payment of principal interest, $18,991.71. So we're going to do the same thing we did with notes receivable, except it's notes payable, the liability. We want to build out our amortization schedule to see what the balance sheet and income statement impacts are related to these notes payable. All right, Allen Schaefer Technology Limited, our principal. What did we borrow? $120,000, 5% interest. Let me get my dollars signs in there. I should have mentioned this earlier. The dollar signs, that will hold a cell if you want to hold a particular cell when you drag a formula down. So let's grab our payment that we calculated, and let's go through the motions. I'm going to drag all these down. If I did this right, this should be 0. Boom. 0. Payment function works. So I'm going to have 5 annual payments of principal interest of $27,716.98, and that will pay off this loan over 5 years. So let's run through this Alpal Business Furniture Incorporated note as well. So $80,000, 6% interest. Throw in my dollar signs. Grab our payment. It's probably a better way to do that. I'm just being lazy here. Beautiful. Balance ends in a 0. That's what we want. We're expecting to pay both these notes payable off in full. Now that we have our amortization schedule for our notes payable, let's see how it impacts the balance sheet and the income statement. In this situation, since these are notes payable, these are liabilities, we have interest expense. We're paying interest for borrowing these funds. So this is an expense that's going to be on the income statement. Let's grab 2023 as expense. From taking out those 2 promissory notes, we have $9,714 of interest expense. Grab 2024. And you can see, just like interest income, if we don't take anything new out, interest expense will go down as we pay off these loans. Let's switch to the balance sheet. A little bit of a nuance with note payables, because with note payables, we need to break out the current portion of the note payable that is due versus the non-current. Current would be anything that's due within a year. Non-current would be anything greater than a year. So let's just start with the non-current piece. And I'm going to make the same assumption we did with note receivable. We're making that payment the first day of the following year. So we're not making it in the year that it's due. So let's grab 2023, our principal. Our interest that is accrued. You do want to include the interest. You can break this out separately. I'm being lazy. I'm just including it with the note payable in this situation. And we'll grab the 2023 balance for Al Powell along with Alan Schaefer. That's the total amount that is owed on those promissory notes as of December 31st, 2023. I do need to break out the current portion, which effectively is just the payment. All right, that's our current portion. Now I got to make sure, because I have the whole amount here, that I back it out on my non-current section. Let's just tighten up our formatting right there. So in this situation, the current portion of the note payables, the 2 annual payments of $46,709, that's the principal and the interest. And the remaining principal balance is $141,288. This is due beyond 1 year. Let's do the same thing for 2024. Going to grab principal and interest. So that is the total amount due, but now I also want to grab the payment, because that is the current portion that is owed. It's effectively the same amount year over year. We're paying the same payment. But I want to make sure I back this out from the total. There is my note payable, non-current liability, and there is my note payable, the current portion that is in current liability. It's broken out on the balance sheet in this situation. Well, let's look at what we have going on here. We're looking at our balance sheet. We have 2 separate buckets. Very similar concepts with the promissory notes, but one is an asset. We have lent money out to other parties, and they are paying it back. That is a note receivable. That is an asset. We're expecting to receive that money along with interest. On the flip side, in the liability section, we have notes payable. This is where we borrowed money. We owe money to people. We're expecting to pay money from our cash account to pay off these loans, and we're going to be paying interest along with paying back the loan as well. Same concept, just the opposite side of the balance sheet, and has different effects on the income statement. Notes receivable will generate interest income. Notes payable will generate interest expense. Well, I hope that'll help you learn the difference between a note receivable and a note payable. I will see you in the next video. Have a good rest of the day. Take care, and goodbye.